Which mortgage product is the best? What's going on, everybody? Welcome aboard the USS Golda Meir. I'm Captain A.P. McKinney of the elite Section 31 team at Ben Kinney Insurance Mortgage and Home, powered by PAC WM. The goal of Section 31 is to provide you with the most relevant data, the advantages and disadvantages of each mortgage option, and to make sure that you are the most educated home buyer in the entire solar system. Using methodology used by the Department of Defense Military Intelligence Operations curriculum, we will provide the intel briefings to our clients based on their current situation, the possible outcomes of potential decisions, and help them to make an informed decisions based on their objectives. So what do you need to get an FHA mortgage? First, let's learn the loan limits. So in Tucson and Phoenix, loan limit's going to be at $420,860. So that is the amount that you can be approved for an FHA mortgage in the state of Arizona. There are some areas that you can get up to $970,800, like San Francisco, but I'm not licensed there, and I don't think any of my clients are going to be doing mortgages there, not anytime soon. Documentation you're going to need is going to be government IDs, so your driver's license, passport, proof of social security number, so social security card, and you're going to want 2 years of W-2. So if you're a W-2 employee that you get taxes out of your paycheck and you get a paycheck every whatever, 2 years of W-2s is sufficient. If you are self-employed or you own a business, we're going to need 2 years of tax returns personal and 2 years of tax returns business and whatever businesses that you have. And if you have partners in your business, we're going to need K-1s. And the K-1s basically show us the percentage of ownership of the partners in the business. If you're going to get money to help you with your down payment or closing costs, we cannot take money as a source of funds that is coming from cash. So if somebody gives you $25,000 in cash and there's no way to verify where that cash came from, you are not going to want to use that money. Not at all. If we can't verify the source, it's not going to be able to be used. Now, on this flip side, if you do get cash from somebody and it's a gift and they write a letter and that letter says, I give this person X amount of dollars, they do not have to pay me back, this is a gift. Then, at that point with that letter, and provided it comes from a valid source, meaning his bank account. So if he gives you cash and says it's a gift, that's a no-go. When it goes from his bank account and it's been in his bank account, or it has proof that he has this kind of money in his bank account, and he sends you the money to your bank account, that's good. Now, the best way to handle that is not to have him send the money to your bank account. The best way to have him handle that money is have him take that money and put it in the escrow account. And when it closes, it's going to save you a lot of time and a lot of paperwork. To avoid getting it from one bank account to another, it just makes it much easier if you put that gift funds into an escrow account. Now, the person who's going to be buying a home using an FHA mortgage, that home is going to need to be their principal residence. That means it cannot be a secondary home and it cannot be an investment property. So at least one of the borrowers on that loan must occupy that property within 60 days of that home closing. On an FHA product, you can buy up to a 4-unit multi-housing home. You must occupy one of those units. You can never use an FHA product with an investment property. And another thing with the FHA mortgage, and this is actually something I have experience with, story to come in the future. So with an FHA mortgage, if somebody buys a home and flips it, if they sell that home within 90 days of them purchasing that home, they cannot finance that home with an FHA mortgage. It's called the FHA 90-day flip rule. And with the FHA 90-day flip rule, there's another issue. And that issue is if the builder or the renovator, if they buy a home and they demolish the home and build an entirely new home on that foundation, is that home going to be considered a new build or a flip? Very, very, very important technicality. And from my experience with one of my files at a client, we did an FHA loan, 30 years, and he wanted to buy a home from a private builder. This guy builds random houses on the south side. And it's supposed to be a new build. Okay, cool. We'll go ahead, we're going through the entire process, order title, and it turns out that this is not a new build. Not technically anyway. It actually is a new build, but technically, by the definition, it is not. Not according to FHA. What was the issue? The builder, he was a contractor, he let his contractor license lapse. So to circumvent some of the compliance rules regarding contracting on homes, he titled the home in his name. That was the technicality that made this deal take another 30 days. FHA will not consider a home that is titled in an individual's name as a new build if an old home was demolished and a new one was put on its foundation. However, if the contractor didn't let his license lapse and he put the home in his business name, that would have been considered a new build, and the FHA 90-day flip rule would not have applied.
This is AP McKinney, and I approve this message.